Welcome. We are going to look at sample question number 3 in financial statements. It's study phase 1, and the question is on asset disposal, especially as it applies to vehicles. And now we are going to consider the VAT. So the following balances, we are told, appeared in the books of Zomo on 1 September 2019. Vehicles, we had vehicles that was bought, that had a value when they were bought at 1.47 million, and there has been accumulated depreciation on these vehicles of 294,000. So that is at the beginning of our financial year. Then during the financial year that ends on the 31st of August 2020, the following transactions took place. On the 20th of February 2020, a new passenger vehicle was bought for 485,100 for cash inclusive of VAT. And then on the 1st of June 2020, an old delivery vehicle which was bought on the 1st of December 2017 for 676,000 including VAT was sold on credit for just over 380,000 included VAT. Then we are given additional information. It says Zomo is a registered VAT vendor. We are told that the standard VAT rate of 15% applies. That should not surprise us. Then it says, in accordance with the VAT Act, passenger vehicles are non-allowable items. In other words, when buying a passenger vehicle, no input VAT may be claimed back from SARS on the purchase. And because we are not claiming input VAT, when we work with a passenger vehicle, we will work with a VAT inclusive amount. Also, in accordance with the VAT Act, delivery vehicles are standard rated supplies. In other words, when purchased, the full input VAT amount may be claimed back from SARS. And what that means for us is that when we look at the delivery vehicle, we are going to work with a VAT exclusive amount. Zoma depreciates all their assets at a rate of 20% according to the reducing balance method. So they always look at the reducing balance and they take 20% away. That's very important. So what is required? It says prepare the following accounts in the general ledger of Zomo for the financial year ended 31 August 2020. The vehicle account, the accumulated depreciation for vehicles account, and a asset disposal account. So that is what we need to do. Now, before we can do this, there are certain calculations that we must first do. So let's do those calculations. Good. We know that the financial year end is the 31st of August. We know that the old vehicle that was sold was purchased on the 1st of December 2017. So in year 1, that would have ended on the 31st of August 2018, that vehicle would have depreciated for only 9 months because it was bought on the 1st of December, which is 3 months after the year end. Good. So when it is sold later on in 2020 on the 1st of June, remembering that there is still 9 months left before the 31st of August. So the depreciation that it will, or the period that it will depreciate for in year 3 will also be only for 9 months. Okay. We were given the VAT inclusive cost price of the vehicle, and we were given the VAT inclusive selling price of the vehicle. But the old vehicle that we are looking at is a delivery vehicle. So when we bought it initially, this amount was claimed back from SARS. And when we sell it, we will have to pay money over in terms of VAT to SARS. And therefore, we are not going to work on the deliveries vehicle VAT inclusive prices, but on the VAT exclusive prices. And that is why I marked it for you in green, because everything that's marked here in green is going to become important now. Then we sit here with a rate of depreciation. Still worked regarding the old vehicle is 20% on the reducing balance. Now let's see what happened here. The vehicle was bought for 588, okay, in year one. That is the only value we had. So we're going to reduce that original value. We're going to depreciate the vehicle by 20% rather, but we are not going to depreciate it for the full 12 months, only for 9 months. So therefore we divide by 12 and we multiply by 9. And then the depreciation in the first year on this delivery vehicle was 88,200. Obviously, it's year one, so the accumulated depreciation will be the same. And then at the end of the first financial year, the reduced balance will be this cost price here minus the accumulated depreciation, and that is just under 500,000. Now, obviously, in the second year, it is depreciating for the full year. So we simply take the reduced balance, which is 499, and we multiply that with 20% to calculate the depreciation. To get to the accumulated depreciation now, we add the 88 and the almost 100,000 together, and we get 188,160. The reduced balance is now the original amount minus the 188, or just the reduced balance minus the depreciation. It will give you the same answer, and that gives us 399,840. Then in the third year, we are 9 months into the year, we are selling the vehicle. So we look at the reduced balance, we multiply it with 20%, but then because it's only for 9 months, we divide by 12 and multiply by 9 again, and we get the depreciation. We add that depreciation to the accumulated depreciation to get to 248,136. And then, of course, if we subtract that amount from the reduced balance, we will see that in our minds, the car is worth 339,864 Rand at this point. Okay, now we need to see. So I put in an amount here of 9114. Where did I get it? Well, let's look at it. If we want to sell the car at this point, we think that's what it's worth, but we were told what we sold it for. In fact, we sold it for, VAT exclusive again, 337.50. And so if we subtract the amount for which we really sold it from the amount that we think it is worth, we see that we in fact made a loss of 9,114 Rand on this old delivery vehicle. Now, what about the new vehicle that was bought? Okay, it's bought on the financial year and is still worth for the 31 August. We purchased it on the 28th of February, so the depreciation is going to start on the 1st of March. 1st of March to 31 August is 6 months. Okay, so we're only going to depreciate the new vehicle for 6 months. And there we have the cost price that we bought it for, but now we are using the VAT inclusive amount because there is no VAT that we can claim back on the vehicle. So we are depreciating the vehicle on its VAT inclusive amount there. Rate of depreciation is still 20%. So how does it work? Well, we take the VAT inclusive price. It's still the first year, so we take that times 20% to calculate the depreciation, but it was only for 6 months, so we divide by 12 and we multiply by 6, and we get depreciation of 480. Okay. So 48,000, 48,500. That 48,500 must now reflect under accumulated depreciation as well, because there is nothing from a previous balance to add. And now the reduced balance will be this cost price minus the 48, and that gives us 436,590. Okay, but now let's see what happened here. These are not the only two cars we have. We have several cars. Now, we not specified what they were bought for. We only know the one that was sold and the one that was bought. So but what we do know is that at the end of the previous financial year, because it was given to us, the total book value of all the vehicles was 1.47 million. Okay. And we were also given the accumulated depreciation on the entire pool of vehicles, that is 294,000 Rand, leaving us with a reduced balance here of 1.176 million. Now, when we are going to calculate the depreciation for the pool of vehicles now, we will have to use this reduced balance. Okay, so let's look at the new book value that we have for vehicles, the amount that's going to appear in our vehicle account. Well, it will be the total book value that we had, that 1,470 for vehicles, minus the vehicle that we sold, its book value, which was, remember, the 588, plus the new vehicle that we just bought for, what was it again? 485,000. Okay. So that is what we're doing. Total book value minus the book value of the vehicle sold plus the book value of the vehicle bought. And that means we now have vehicles to the tune of 1.367 million on the books. And that's obvious because the vehicle that was sold was a little pricier than the vehicle that was bought. Okay, now let's calculate the reduced the depreciation for our pool of vehicles. So first thing we have to do is look at that reduced balance and multiply it with 20%. But now remember, when we dispose of a vehicle, we take the depreciation, in fact, the accumulated depreciation of that vehicle out of the books. And this old vehicle still formed part of that reduced balance. So we have to subtract the depreciation of the vehicle that was sold. And obviously, that reduced balance there did not include the new vehicle, so we have to include the depreciation of the vehicle that was bought. And when we do that, we see that the depreciation is 223,734 Rand. Now, what about the accumulated depreciation? Well, we now have the accumulated depreciation balance, okay, that we previously had. And to that, we can add this total depreciation here. And this total depreciation already made provision for the depreciation of the vehicle that was sold in that year, but we have to take it out of the books completely. So we have to subtract the accumulated depreciation of that old vehicle as it was at the beginning of the year. And when we do that, we get an amount of 329,574 Rand. Okay. Now we take these numbers that we've just calculated. Maybe I should just make that one a little bolder as well because the others were bold. So we bring these three numbers down just here for sanity's sake, so that when we work in the ledger accounts, it is easier just to copy these values. So the total book value is 1.367 million. The depreciation is 223,734,000. The accumulated depreciation is 329,574, and the reduced balance is just simply the difference between the book value and our accumulated depreciation. So this is now the reduced balance that we have on the book. So if we don't buy any new vehicles or sell any of the old vehicles in the following financial year, then this is the value that we will use when we calculate the 20% to calculate the depreciation for the next year. Okay, so just remember these three amounts. We're gonna work with them. So now let's look at our ledger accounts. So obviously for vehicles, which is an asset account, we expect that there would have been a positive balance at the beginning of the financial year that was brought down from the previous year of 1.47 million that was given, remember? Now, what we also know is that we had on the 1st of June that asset disposal. Now, that would have been recorded in General Journal 9 because it is the 9th month of the year. And we can just put the amount for which we bought it in there because that we are going to subtract from the balance. But we also know that on the 1st of May, we bought a new vehicle, and we must go and look and see was that new vehicle bought for cash or was it bought on credit, and we see it was bought on cash, so the money is going to leave our bank account. Money in the bank account we will see in the I said debtors journal. This was wrong. Let me just quickly fix this. This will be, of course, the cash book payment journal for the 6 month for month 6. Okay. And the amount for which we bought it is 485,100. Now it is clear by looking at the numbers that our debit side is higher. So we can go and we can total what's on the debit side. We put the same amount on the other side of the equation to balance it. And now we know that we will have a new balance, and that new balance will be the difference between these two amounts. And of course, we are going to bring down that same balance to the beginning of the following year, and that will be the balance that will be on our books when we go through this exercise again next year. And now we hope that this balance corresponds with what we calculated, 1.367, and it does, so we know that our calculation was correct. Now let's look at the accumulated depreciation. Now the accumulated depreciation, once again, we are going to start with a balance that was brought down from the previous year and that was given for us. That is the balance. Then we know that the depreciation that we calculated here throughout the year, and we ignored the depreciation of the old vehicle because we know we're going to take it out in any case, that transaction in the general journal is for 223,000. On this side, we had the asset disposal, and of course, we have to take out what it was worth at the beginning of the financial year because the other amount is already included or was accounted for in this depreciation, and we get 188,160. Obviously, the credit side is the higher amount, so we add it up on the credit side. We bring the balance over to the other side, and then here we now record the new balance, and the new balance is the difference between the 517 and the 188. We get 329, and of course that is the balance that we carry over to the beginning of the new year. Okay. So the only other thing that we now have to deal with is the asset disposal account. And here, this is really the contra entry of what we had here. because vehicles is not our only asset. So when we sit with our asset disposal, we need to know what this was for. Okay, so it was for vehicles. It was recorded in our General Journal 12, and of course, it was the amount at which we originally bought it for. On this side, we have the accumulated depreciation of vehicles, also General Journal 12, and the amount that we have there is the 248136. Okay, so 248136 was the accumulated depreciation as we read it. Oh, sorry, I'm on the wrong sheet. As it was given to us here. No, it's not. Let me just quickly see what I'm doing wrong here. And where did I get this amount? I said it is from D13 on the previous sheet. So D13. Oh, okay. It is the accumulated depreciation of that vehicle that we sold at the time when we sold it. Sorry about that, guys. So that is it. Then obviously this is the bigger amount. Okay. We bring it over to that side. This is clearly then the balancing amount will come on this side. Okay. And so that's the debtors control. Why debtors control on this side? Debtors control on this side because what we did is we sold this on credit. Okay. And we know that we made a bit of a loss. Now we can just put in that loss of asset that we calculated here, the 9114, or we can say, is it true? If I take the 588 and I subtract the vehicles and the debtors control amount, do I get that 9114? Yes, I do. Okay. And there's no balance here at the end of it, because remember what we are doing here with the loss on sale of asset, we will show that in the profit and loss account, so that all the other accounts like this asset disposal will be zeroed. Okay, so that is really the amount that we're looking for, and it makes sense because we already had it. So this is the amount at which we bought it. This is the amount at which we sold it. This is the amount with which it depreciated, and that leaves us with a loss on the sale of the asset of 9,114. Okay, and that is how we do this question. Thank you.